Hi folks, Marc from Mabel Capital Partners here. And in this video, we're going to go through a bunch of different data that I've culled together and processed and tried to synthesize down into one cohesive message about where we are with the state of the multifamily market, where we're headed, and my best guess at where things are going to be going. As always, I will be the first to say I don't have a crystal ball. A lot of this data, it is really informative and helps color my opinion, but the purpose of this video is not to tell you where the market will definitely be or create any kind of certainty around my opinion. But as always, I hope you gain some insight and some data to help you generate your own opinion on where the multifamily market is heading. So without further ado, we'll go ahead and get started. So first, we'll start off by taking a look at the economy. So a few data points to pay attention to here. First of all, last Friday, we had the payrolls, non-farm payrolls data come out, and that was a beat, meaning that that number came out much higher than where economists' expectations were. Not only did that beat, but also because of increased labor force participation, we had the unemployment rate that actually dipped down to 3.8%. And then also CPI has come out recently. It was running hotter than expected in March. It rose 3.5% year over year, and that topped analysts' expectations of 3.2%. Now, on a core basis, core CPI is where they strip out the really volatile parts of CPI. So that's food and gas inflation. On that basis, we were actually up larger than that, so 3.8%. And that topped economists' forecasts of 3.5%. So again, across the board, pretty much the economy is really resilient, running much hotter than I think even the most optimistic economists were saying at the beginning of this year. And so as a result of that, the market is starting to price in some of this stubbornly elevated inflation and a really strong job market right now. So what does that mean? That means that potentially there will be less cuts for the rest of the year than a lot of analysts were calling for at the beginning of this year. Right now, Fed funds futures market is pricing in just one cut of 25 basis points for the rest of the year, whereas at the beginning of the year, that market was pricing in about 150 basis points for the rest of the year. So despite what the Fed is trying to do and slowing down the economy, jobs are still coming online, wages are still growing, inflation is still very much elevated relative to the Fed's goal. So as a result of that, we could not only see Fed funds rate stay elevated, but also as a knock-on effect, mortgage rates. And that should matter to all of us as real estate investors. Now taking a look at a survey done by CBRE. This is the 2024 U.S. Investor Intention Survey. It's where they go out to a bunch of different people that are stakeholders of CBRE, a lot of their clients, a lot of investors in the market, salespeople, and they ask them what are their thoughts on the state of the market and their forecasts for next year. And basically the biggest takeaway was in terms of the impediments that are slowing down the investment activity for 2024, they pointed to three major factors. One is the higher for longer interest rates that we just spoke about. Number two is tight credit conditions. We've seen a lot of banks pull back on their lending for multifamily specifically. And then also number three, deferring buyer and seller expectations. We're still seeing that just anecdotally on our side, this wide bid-ask spread between where sellers are willing to transact and where buyers are willing to pay for assets. Now, moving on down, another takeaway from this survey is the fact that more than half of investors plan to buy more assets in 2024 than they were in 2023, which is actually a great thing. It means that there's a higher level of conviction among the investor community. And compare that to about 40% plan to sell more in 2024 than they were in 2023. Again, that same certainty, that same level of higher conviction relative to 2023. I don't think we're out of the woods yet, but at least the investor community feels a little bit more this year than they were in 2023. Investors also favor higher yield and income strategies, according to this survey, such as opportunistic and core plus real estate plays. So for folks who may not be familiar with core plus and opportunistic, I guess the big takeaway there is that investors are looking for more higher yields and stable income for their capital this year. There's still a ton of dry powder, and those are the types of investments they're looking for this year. Just to continue in terms of takeaways, investors are favoring the Sunbelt cities, some of the high-flying markets that have been kind of the darlings of the investment community for the last 5+ years, as well as high-growth secondary markets, and even some large East Coast markets in 2024, like Boston, New York City, and Washington, D.C. Now, among asset classes, the multifamily and industrial sectors remain the top picks for investors, with a strong preference for high quality Class A properties and strategic value add opportunities in Class B and C assets. Now, across the board, investors are bracing for pricing discounts, and especially in the office sector and shopping malls, that's reflecting a cautious but also a realistic approach to asset valuation, and lesser discounts are expected for multifamily, industrial, and logistics assets, with grocery anchored retail centers seen as the most stable. Just at a high level, despite lingering economic concerns, the outlook for 2024 is much more positive than it was for 2023, with a majority of investors ready to increase their buying and selling activities this year. The anticipated decline in interest rates and a stabilization in financial conditions, that could bring in more robust activity and a more robust recovery in investments this year. So that's a little bit on the CBRE survey of investors, and their opinions of the market often can precede what goes on in the market. So much of investments in general is based on confidence in the investment community. And from what we're seeing, I think people are feeling a lot more optimistic this year than they were at the same time last year. So now let's talk about some of the headwinds facing the multifamily asset class. So this is a big theme in the market, is the fact that the multifamily market is facing a huge debt maturity wall. What does that mean? There's a lot of US property debt that's maturing over the next 3 years. Now, this number really varies pretty widely depending on the source, but there have been quotes of as much as 2 trillion in the next 3 years. And really, banks across the US are facing these challenges as trillions of property debt are set to mature. And that leads to a pressure on lenders that basically, according to Marc, they're going to have to decide whether or not they want to go into extending more loans to the multifamily or wider commercial real estate market, or they want to let those loans mature and let those borrowers move on to maybe some of their competitors. Now, as I said, that number varies pretty widely. The MBA, Mortgage Bankers Association, estimates that number about $929 billion in the coming year of commercial and multifamily mortgages. But regardless of what number you use, it's a huge amount of debt coming due. And bank maturities are actually the largest share of that debt. Marc also goes on to say that many lenders holding this debt, including banks, haven't yet written down the value of those loans. Instead, they favored the extend and pretend. That's basically where they may have a loan coming due. They get with a borrower and they say, okay, we know that your debt is coming due in the next year. Instead of forcing you to refinance or to find another lender, we're going to extend this loan and pretend that the valuation of this loan has not been written down. So that may come to a crashing halt, or it may result in some form of slower burn in the coming years, as banks are going to need to either sell that risk or boost their capital or even lower the volume of new CRE lending. And for us as investors, that could mean that there's just going to be less financing sources, less capital sources for the next time that we need debt on our multifamily acquisitions. Now, there's also another factor that's severely hampering our market, or could be a headwind in our market. That's the amount of supply that's challenging many multifamily markets across the nation. Now, to put some real world numbers behind that, in this past quarter, we had 135,000 units completed, and that's actually on a year-over-year basis, 479,000 units. That's a massive number. Hopefully you can make out the chart there, but it's a very, very high number. In fact, it's the highest since 1986. So almost 40-year high in terms of supply coming online. However, if you look at the supply versus demand for housing units, that gap is starting to narrow, which is a good sign. Rental growth is basically non-existent, and that's on a national basis. Obviously, that's going to be impacted based on where you're investing. But as of March, about 11 major markets reported rent reductions of 2.5% or more. And they were also the markets where we're seeing the highest inventory growth. So it's no coincidence that many of the markets that were just a lot of developers bringing units online, like Austin, Atlanta, and Dallas, those are some of the very same markets that are seeing the largest rent decreases. However, in some of the markets, like the Midwest and Northeast in particular, where new supply has been much more restrained, rents are actually still going upwards, which is a good sign. In the Midwest, for example, the rents reached a new high, with median rents climbing 5.3% in the last year to about $1,456. So kind of mixed signals based on where you're investing. Now, I gave you a little bit of the headwinds. I'm going to talk a little bit about the reason to be optimistic about the multifamily market. Apartment demand is still very, very strong. The absorption rate for 2024, so that's the number of new units that are occupied across the US, that's 103,000, almost 104,000 units, with the annual number reaching 317,000 units. So it's still below where the supply was. And again, that number was in the 400,000 range. So still below, but it is an elevated number relative to history. And that's driven primarily by sustained wage growth. Wage growth now has increased and surpassed rent growth for the last 16 consecutive months, which means that people's ability to afford rent, or their share of rent that they're spending, of their income, I should say, that they're spending on rent, is actually going down over the last 16 months, which is really, really a good thing to see. Also, steady job creation. We talked about the jobs number a little bit earlier. Demographics, and then also the ownership affordability gap. In terms of the last two, the demographics and ownership affordability gap, it is still much more attractive to be renting today, to the tune of more than $1,100 per month, that it's actually cheaper to be a renter than owning. And some markets are actually still seeing rent growth despite all of the supply challenges I mentioned in the prior slide. So I mentioned the Northeast and the Midwest. So even despite those headwinds that we talked about, the 50-year supply peak that we reached, some of the tougher lending conditions that we're seeing, rent is still stable. There's still investor optimism around multifamily for the next year or so, and supply is actually starting to recede. So the units that are coming online, the number of units is actually starting to decline. And what we're seeing is there are a lot less starts, a lot less permitting going on for developers. And so what that could mean is that about a year, 2 years from now, when a lot of those housing units that are being permitted right now or have been permitted in the last 6 months are going to really decline. And what does that mean? That means that it might be a great time to buy today, potentially, depending on your market, obviously, if you think that you can withstand some of this short-term volatility in the market and stick it out for 1 or 2 years. Another reason to be bullish on multifamily is, frankly, a lot of the bigger institutions are starting to wade back into the market. So Blackstone is betting really big on multifamily. They recently acquired Air Communities for $10 billion. It was the largest and highest quality apartment portfolio that they've ever acquired, according to their co-head of real estate, Nadeem Meji. And for those who don't know Blackstone, by the way, they're the world's largest alternative asset manager. And so what they do in the market has ripple effects on the entire commercial real estate market. And so when they're bullish, it can have a pretty outsized effect on really for a lot of other players in the market. One of their president, their COO, Jonathan Gray, recently said we're heading into a better environment with inflation and the cost of capital environment moderating. Real estate values are bottoming, and we would expect deal activity to pick up. We continue to see robust fundamentals, and our real estate will emerge from this cycle even stronger than before. So again, they're calling the bottom. Notably, they've got about $65 billion in dry powder going into the broader real estate mandate. So that goes not just in multifamily, but across data centers, logistics, hospitality, and student housing. So a big player, one of the biggest, in fact, is really starting to be bullish on multifamily, which is a good thing. Now, another piece of positive data for us, Jay Parsons. For folks who don't know Jay Parsons, he's a real estate economist. He's an investor. He's a speaker. He advises a lot of large players in commercial real estate, a lot of institutional investors, REITs, smaller investment groups, lenders. So he's somebody that when he speaks, a lot of the market listens. He actually has appeared many times on Bloomberg, CNBC, the Wall Street Journal, New York Times, Financial Times, Economist. So again, he's just a really important voice in the commercial real estate market. So these are some things that he recently posted about on his Twitter. He said, as of Q4 of 2023, no bank lending category had a lower rate of non-performing loans than multifamily across the entire bank financial reporting world. So you can see that chart on the right-hand side. That was pulled from Jay's Twitter account. And again, that's him saying that basically there are no loan categories that are performing better than multifamily, which is a really good sign. Despite everything everybody's saying about this debt wall coming to pass and a lot of these loans souring and there being widespread distress, that's not really materializing right now. So he points out the fact that while multifamily loans have gotten a lot of negative press, these loans are really not starting to implode. He's got a few takeaways here that he points out. Most traditional multifamily bank loans are actually relatively low risk, low leverage deals on stabilized apartments. He's saying that most of the distress that you are seeing in multifamily loans is focused and concentrated in only a few niches. For example, New York's rent stabilized apartments, which saw their values sink as a result of new legislation, new regulations there. And that was, by the way, the same thing that hurt the New York Community Bank recently, which made a lot of headlines, is due to the same regulations. He also says that industry players know that more risk is actually concentrated in debt funds than in banks, which went heavier on the higher leverage floating rate loans that have made headlines lately. So good to know that banks own less of that floating rate debt. He also says in point number 3, unlike other CRE sectors, banks play a secondary role in multifamily behind the agencies, Fannie and Freddie Mac. A recent uptick in delinquency was largely traced, and I should say in delinquency among those agencies, was largely traced to isolated cases. But even still, non-performing loans remain relatively low for both agencies. And then finally, he says, we'll almost certainly see more non-performing loans across all categories in 2024, but it's also encouraging to see this sector hold up much better than expected in 2023 amidst significant turbulence, showing more resiliency than perhaps even optimists predicted last year. So again, despite everything that pundits said about these loans going bad in multifamily and that causing a bunch of ripple effects throughout the multifamily world, that's not really materializing, and so that's a good thing. That pretty much concludes my deep dive into where the multifamily market is, where I think we're heading. As always, there's both reasons to be optimistic and pessimistic on the state of outlook for the multifamily market. We summarized a bunch of different data and sources throughout the CRE market. And I really hope that you've enjoyed this breakdown and the data and the insights that we've curated. But we'd love to hear what your thoughts are on the market and your thesis for the near term in the multifamily market. Reach out, leave a comment, get in touch with us. We want to hear from you. So we'll sign off as we always do at Maple Capital Partners. Be kind, be charitable, and invest wisely. Thanks, folks.